Alright, here we are on our risk of ruin analysis spreadsheet. Now this spreadsheet is also available for download with this session, so please make sure to download it and then later input your own numbers to see what your risk should be and to play out different scenarios of risk of ruin. So what is risk of ruin? Well, ruin means being financially ruined, i.e. losing all your account. Okay? So let's just take a look at this example and explain what all of this means. So in this example, we're assuming that we have $20,000 of starting capital and that we're risking 5% of our account per trade. All right? This minimum risk number of $100, this you can choose what it is. Right now, this is going to be an example of us trading the S&P 500 futures. The reason why we put a minimum risk of $100 is because even if you're only trading one lot, one S&P contract, which is the smallest amount you can trade, and you have a 2-point stop, which is a pretty tight stop. Your stops, unless you're an ultra active scalper, should not be less than 2 points usually on the S&P. A 2-point stop with a one lot is $100. So to keep this realistic, we gotta keep the minimum risk at $100 if it ever drops to that level. Because we know in reality, in real life, we would be trading at least $100. Okay? So what is this showing you? Well, this is basically showing you at 5% risk, how many losing trades in a row would it take for you to lose your whole account? i.e., what is the risk of ruin? Well, so let's take a look at this. If we start at $20,000, 5% risk is 1,000. So your first trade you would risk 1,000. And let's assume that's a loser. It becomes 19,000. Well, now 5% is 950. Then that's a loss. It goes down to 1850, and then 5% of that is 902, and so on. You understand what we're doing here? So we're seeing how many losing trades in a row would it take to lose all your money. So let's take a look at that. In this instance, at 5% risk, it would take 66 losing trades in a row, right, for you to have lost all your money. But actually that's not true, because at 60 you've hit $500 and you need at least that to cover your intraday margin, but it should be, usually over 1,000. So we're saying somewhere around 50, 55 trades or something, you've lost all your money. You can't trade anymore. All right. Now, 55 losing trades in a row, the odds of that happening are probably 1 in a few hundred million. So it seems like you have very little chance to lose all your account here, right? Seems like it's very small chance, like it's just not going to happen. But wait a minute, before you decide that, let's actually take a look at this. We had just been explaining that you're pretty much ruined before you lose all your money. If you've lost half your money, you're going to need to double your money just to make it, and the psychological risks and everything that's going to happen once you're at that level is almost going to guarantee that you're going to lose your money. So in reality, you're pretty much ruined once you lost somewhere around half your money. And it's not impossible to make it back if you're extremely disciplined and you just take your time and do it gradually, but you never want to be at that position to begin with. So looking at this, how many trades in a row would it take to be down to half your money? Well, it would only take 14. Right here, you're down to $10,000. Now, 14 losing trades in a row also doesn't seem that high odds. But depending on your accuracy and depending on your frequency, i.e. how often you trade, there's a likelihood you can run into that stretch. And not just that, think about this, it doesn't have to be in a row. Let's say you could lose 8 trades in a row, have one winner, and then lose another 7 trades in a row. That'll give you pretty much the same effect. So it doesn't have to be all just in a row. But what this is showing you is that if you're risking 5% of your equity on any given trade, you're not in a very comfortable position. Losing half your equity is going to be something that can readily happen, which is not what you want. So it seems like 5%, even though it seemed like it would take 50, 55 trades to lose all your money with it, in reality, 5% seems a little high. So in reality, what you want to do is experiment. What would be a better level? And so let's try like 2%. Okay, as we'll notice with 2%, now it takes, about 109 losing trades in a row to be down to $1,000. All right, so that's great. What would it take to be down to half your capital? Well, now this is more like it. It would take 35 losing trades in a row. That is extremely unlikely, right? Unless you have almost horrible accuracy and you only win 1 times out of 10, to have 35 losing trades in a row is extremely unlikely. And to have a couple stretches of, 10 losing trades in a row, then a winner, then another 10, and another 10 is also very unlikely. So now, this is seeming much more safe, right? If you risk only 2% of your capital on any given trade, this is showing that you're relatively pretty safe, right? That your risk of ruin is extremely, extremely low. And this is what we want. So here we would start at $400 risk, and as our account got smaller, based on the percent risk model, our dollar risk gets smaller, right? And this is what kind of is protecting our capital as we go along. And so what would it take here to have 25% drawdown? Well, it would take about 15 losing trades in a row. So that's pretty acceptable. 15 losing trades in a row is a pretty low odds thing. Even having 2 stretches of 7 or 8 losing trades in a row is not something that happens very common. So if it were to happen, you would still only be losing 25%, which is still a manageable amount. And so this makes sense. Well, let's see what happens if you go to 1% now. Yeah, 1%, it would take us almost 160 losing trades in a row to be completely out, right? And it would take us 69 losing trades in a row to be down to half our money, which is extremely, extremely, extremely unlikely. Probably 1 in a several hundred million chance that that would actually happen. And to go down to a 25% drawdown, it would take almost 30 losing trades in a row. So now things are looking great. If you're using only 1% of your capital at risk, this is looking good for you. You're pretty safe. And so, in general, what I recommend, and what we've personally used as risk in our own account, is anywhere between 1 to 2%. Maybe 1.5%, that's usually a good level. I traded at that level for a couple years when I was starting out, 1.5% risk per trade. And that allows you to grow your account pretty rapidly too, because it works on the upside. I mean, think about this for an upside scenario. Let's assume you've built up your skills enough, you've created a good strategy that has a 0.2 expectancy. So nothing huge, but still very respectable. You have a positive expectancy of 0.2. And let's assume you take a couple trades a day. So over the course of a year, you have 400 trades that you take, right? And let's assume you take 1.5% risk per trade. Well, how much percentage return? We're going to do a quick approximation here, not the exact compounding numbers, but it'll be instructive. What percentage return will you make over this year on your account, even though you're risking such a small amount per trade? Well, let's take a look at that. Let's just do the formula right here. So we have a 0.2 expectancy, right? Multiplied by a 1.5% risk per trade, all right? Multiplied by 400 trades a year. What do we get? 1.2. What does 1.2 mean? Well, 1.2 means 120% return. So even though you're risking such a small amount, 1.5%, if you were able to manage to create a trading strategy with a 0.2 expectancy, which isn't very high, and you had a frequency of a couple trades a day, by the end of the year, after you've netted all your losses and all your wins, you'll be up 120% on the account. All right? That's very respectable. If you have a $50,000 account, you've just made $60,000. Of course, with some compounding, it'll actually be higher than that, but I'm just giving you a general thing. So don't think that if you take small risk, right? If you take a 1% or 1.5% or 2% risk, that yes, your risk will be low, but you can't make any money. That is not true. You can grow your account, and that's how I personally did it. I'm not telling you this as theory. That is exactly how I did it. I was at 1.5% risk, all right? And I had somewhere around a $45,000 account when I started, and I just started compounding it. After an initial year or more of intensive study of the markets and just learning everything I can from many different sources and hundreds of hours of practice and study and all that working on myself, I became consistently profitable. And once I did that, I was able to compound my account very quickly, several 100% compounding. All right, but it was quickly and it was patient at the same time. It was gradual. It was trade by trade, month after month. I wasn't trying to make a big home run anytime. This is not get rich quick. It's not going to happen like that for you if that's what you're thinking. It's got to be gradual. And of course, if you happen to have a large account, let's say you have $100,000 or $200,000 to risk, right? Well, 1.5% of $200,000 is $3,000 a trade. So that's pretty decent. Even though it's a small percentage, that's still good in trade terms. And if you get 120% return on that, well, you've just made $250,000. So it's all relative based on your account size. But the point is that don't think small risk per trade won't make you big money. It will, if you do it correctly. Even the biggest traders, the legendary ones that you hear about in the Market Wizards books, that's generally how they did it. Small risk per trade, don't ruin yourself, don't let your psychology get in the way, and gradually build it up. And so, I can't tell you how liberating it feels to know that any given trade, any one trade, has very little impact on you, right? Even you don't have to be scared. When you're only risking 1.5% of your whole account per trade, no one trade can ruin you. No one trade is significant. You don't have to be trading scared. It liberates you to trade with good psychology, to be more relaxed, and to let the overall probabilities play out over the bigger picture, over a larger number of trades, right? That's what the key thing is. And this gets us back to that point of you have to size your positions low enough to be able to realize the expectancy of a system or strategy. Okay? Even if I had a positive expectancy strategy, a great one, if I go all crazy and start taking 15 or 20% of my account risk on any trade, which some traders do, they'll take a big chunk and they'll risk it. They'll just trade way too big of size for their account because they're impatient and they want to make money quickly and they don't want to wait to make big money. Well, look what happens if you have 15%. 5 losing trades in a row and you've lost half your money, right? Look at this graph, what happens to it. Just a steep drop off and you're done. So yeah, while it might be tempting to make a lot of money, it just doesn't make sense financially. You will never make it that way. And here, if you were trading, you would be scared out of your mind on any given trade. Every trade would be very important to your account. The key thing is to make every trade not that important to your account. Okay, big deal. That's $300, just $20,000. I can live to trade another day, right? And that's what mind frame you want to be in. The funny thing is that trading psychology is extremely important, and we'll be getting into it later. But just by sizing your positions correctly and using a good position sizing model and using low risk per trade, somewhere like 1 to 2% at most, that takes care of a lot of the psychological issues you deal with, because you stop being so scared about every little trade and you can just execute correctly based on process. And that's what it's really all about. Now, a couple more quick things before we wrap up here. If you happen to trade multiple markets, so you're not just trading the ES, for example, you're trading ES and gold and oil, Or you're also trading, stocks, and you're trading several stocks at the same time, or you're a forex trader and you're trading, different forex pairs, whatever it may be. Make sure to look at your overall risk. If you're trading more than one position at the same time, okay, make sure to look at your overall risk. So yes, you want to risk 1.5% per trade. But if you might have, let's say, 8 trades on at the same time because you're a stock trader or you trade different futures market, that would be 12% risk of your overall account. Now, while these trades might be somewhat independent, here's something you have to realize about the market. Even independent markets, even ones that aren't correlated, that don't move together, if there is some event, some unforeseen event in the market, some big crash or a major sell-off, correlations shoot way up. Things that weren't correlated before will become correlated and everything will sell off at the same time. So if you think you have independent positions and you're sizing each at between 1 to 2%, if something were to happen and you never know when it could happen, it could be sudden, it could be a September 11th type event, who knows, everything will become correlated, everything will get sold, and you will have a big loss. So you got to take that into account and set an overall portfolio risk. So let's say you might have 1.5% risk per trade, but no matter how many positions you have on, you limit all of them, let's say, to 5% at one time. So if you have, let's say you're trading stocks and you have 6 stocks that you're trading at the same time, right? And you risk 1.5% per stock, well, you can't do that because that'll give you 9%. So you got to take it down and risk something like 0.8% per stock if you're trading 6, to leave it, let's say, at 5% overall. Now you choose these, but just make sure that it's not too high, because yes, those situations are rare, like September 11th, but you never want to be there when they happen, right? You want to have your risk protected at that point in time. Now, of course, this assumes that you're going long, that you're buying, right? Because correlations really go way up in a crash type scenario. If you're short overall, if all your positions are short, you have a bit less to worry about. Yes, there could be some great news and everything starts going up, but in general, fear is much more powerful than greed, and unrelated markets are not just going to fly higher because of some news. You still should be careful about your overall risk. Now, of course, if you have some short positions and some long positions, those essentially do cancel each other out in terms of overall portfolio risk. So, if you're trading 5 different markets and you have 2% risk in each, that seems like 10% risk, but you have 3 shorts and 2 longs. Well, in reality, your net exposure to overall market movement, a crash type scenario, is only 2%. And that's to the short side because you have more shorts, so that's okay. All right, so you got to take all these things into account. But my warning was, if you're long only, or even if you're short only, just be careful of the bigger risk, okay? Even in uncorrelated markets. And the second thing I just want to mention before we wrap up is the concept of daily drawdown limits. Right? So right now what we have is, 1.5% risk per trade, and that's low. And we just take the trades as they come. But let's assume you have a day where you just take, 4 losers in a row or 5 losers in a row. And you're active. Let's say you usually have 7, 8 trades a day. And you've had 5 losers in a row and you're down 7.5% now. Well, that's still safe and you're not going to have risk of ruin or anything like that. But there's 2 things that can happen here. One is that particular day you just might be reading the market wrong. You just might be off. Who knows why? You could be off psychologically, you can be off just in your market reads. And so if you don't cut that off, it might just keep going on needlessly. Now, we're not systems traders. If you have a system, a mechanical system, then you should take every single trade and that's it. But if you're a discretionary trader, sometimes you're just reading the market wrong. Sometimes you're off. And so having a daily limit within the day, something where once you cross that, you stop your trading for that day, is very helpful. Because for one, it saves you from those times when you're just completely wrong about the market and you keep taking one trade after another wrong. And two, even if you don't have a massive loss because your risk per trade is low, coming back to trade the next day, if you've just let one trade and after another lose, is very hard psychologically. But if you've been able to stop it while you were having several losers in a row, then it's easier to bounce back the next day because you don't let your losses accumulate too much on any given day. Now, this is not the ideal thing to do from the optimal perspective. You should just keep trading normally regardless of your past losses. But, we're human beings, and if it helps your psychology, set a daily loss limit. And maybe that's, 3 or 4 losers in a row. Maybe that's 6%. If you go down 6% on one day, you stop trading for that day, right? Because another thing that's going to happen is if you keep trading, you might start getting emotional and start having revenge trading and trying to make it up, and you're just going to make mistakes. So this saves you from doing that. So that means you have your overall drawdown limit of, let's say, 25% of your whole account. Then you have a daily drawdown limit, like within a day you'll stop if it gets to a certain point to protect yourself, and you'll have an overall portfolio limit in terms of risk if you're trading multiple positions. Okay, so just keep all those things in mind. They'll be very, very helpful. So I hope this has helped. Download this spreadsheet, use it, play around with some numbers, see how it affects your own account, put your own capital in here, put your own risk per trade, and see what happens. Okay, so do that and then continue with the sessions.